I'm Brandon Munro. I'm the Executive Chair of Bannerman Energy Limited. We're an ASX and OTCQX listed uranium developer with the very large scale and advanced Tango uranium project in Namibia. I've come into this position after being in the uranium sector since 2009 when I moved to Namibia and lived there for 5 or 6 years. And before that, I was a corporate lawyer with a consistent thread through my career of mergers and acquisitions in the equity capital markets context.
My name's Todd Ross, and I'm the Managing Director and CEO of ASX-listed company Nordic Nickel. We have a district-scale nickel exploration project in the northern part of Finland, in the central Lapland greenstone belt, where we already have a maiden resource out, which we updated recently, contains 860,000 tonnes of nickel, 40,000 tonnes of cobalt, 22,000 tonnes of copper. That's on a 240 square kilometre land package, which we've only just started to scratch the surface on. So it's a pretty exciting part of the world. I came into this role as MD and CEO after 25 years in banking. Last 10 years, I was working for BNP Paribas, French companies based in Perth, Western Australia, predominantly focused on structured debts, project financing, commodity derivatives, and had a client base of around 23 clients in the end when I finished up at BP.
Guys, thanks so much today, for joining us today. We all got the memo about the white shirts. That's good. Glad that happened.
I'm missing a palm tree, Matt. I'm the only one with something green in the background.
We'll organise that for you next time.
But you're both in warmer climes than me, believe me. 2 degrees here at the moment. Look, today we're going to talk about M&A and and possibly in the realms of funding in the context of M&A. It's a time for M&A. We've been dealing with one over the last week. Karora and Westgold announced their intention to merge, and it kind of threw people. It was quite complicated for most people to understand. So therefore, I thought we'll go through this little educational session today. We're going to start at the beginning, end at the end. Always good. So we'll start with Brandon. M&A, why does it exist? What are people hoping to get out of these mergers and acquisitions?
Well, there's lots of different forms of mergers and acquisitions. We tend to be more focused on public equity capital markets because you and I and Todd, we tend to be speaking mainly to investors. So we need to remember that that's only really a small slither of the broad field of mergers and acquisitions. Most of what takes place are private treaty acquisitions, where one business is buying a portion or a unit of another business. Let's leave that to one side, although the principles are often the same. In the public capital markets, there's a theoretical justification for M&A, and then there's the reality, and it's often the personalities and the particular quirks of companies and sectors that get in between those two truths. Let's open up with a few of my ideas on the theoretical benefits, and I'm sure yourself and Todd will add to some of those. You start with concepts such as synergies and cost savings. So the classical M&A deal is a couple of resources projects down the road from each other. They can either pool their resources for a common development. Sometimes we saw a very effective one, for example, with Australian Vanadium and Technology Metals, where they combined because they were basically two sides of the same ore body, and it just made a whole lot of sense that they were able to consolidate that big titano-vanadium ore body and develop it as one rather than compete with each other for infrastructure and customers and so on. You do sometimes see genuine operating synergies. What I would like to see more of is a sharing of corporate costs, but unfortunately, a lot of the time when there should be M&A, you've got management team, boards and other stakeholders on the inside of companies who are trying to cling to jobs rather than, doubling the number of assets that can be managed by the same team.
Okay, and Todd, for you, I mean, obviously listening to what Brandon said, that's coming from a lawyer's point of view, and by the time it gets to someone like yourself, what are the demands? What are the problems that some of these companies are trying to solve by doing this, as far as you're concerned?
Yeah, look, I mean, most of my experience was more on the corporate ends, and on the structured debt that sort of came with the M&A process, typically. So a lot of it was driven by synergies, driven by processes that were already underway. I think that the challenge, as Ben's already kind of alluded to, is often the egos that perhaps get in the way, or the misalignment of strategy. If there's not a clear strategy that's really articulated from the outset about why this is being undertaken, that's when normally things don't go well, or they haven't achieved the outcomes that they were hoping for. So there's, from a debt perspective on the banking side, clearly you can structure up anything around the deal that makes sense. Often these things have to be done in a fairly short space of time. It's got to be aligned with an equity raise or a capital markets raise that come through that process, or some other sort of capital structure that comes along with the debt. So the challenges are how they all work together as well, and the security packages that are shared, and the way those covenants are all going to be articulated and outlined throughout the debt package. There's all sorts of different variances that would all had experiences in the past. I think for me, fundamentally, the question is always coming down to the strategy, the alignment of management, and really those objectives that are trying to be achieved.
Right. Okay. Because when I look at these deals, and we've seen a few last year as well, which were kind of signpost as mergers of equals, and nothing could be further from the truth. It was companies in potentially terminal decline and needing to signal to the market that these synergies, this cost of capital, and the plan would change the fortunes of both. I mean, Australia's been through a kind of pretty good time, well, certainly when it comes to precious metals of the last few years. Maybe the last 6 months is a little bit different. When you look at these Aussie deals happening, what are one of the first things that you look for that perhaps would concern you in terms of the way that the deals are structured, or the way the plans are laid out? I mean, Brandon, how do you look at these things?
You've got to look at, what is really the guiding principle behind the merger of equals, or acquisition for that matter. What you said about cost of capital has been very real, particularly in precious metals in Australia. If you look at gold companies, for example, it's a very deep pool of opportunities. There are hundreds of gold companies, and the cost of capital over the last several years has led a lot of M&A activity, where it's basically, as long as you don't do something silly, 1 + 1 can equal about 2.5. And that's because these companies are merging up into much bigger entities that therefore have more liquidity. They tend to have more exposure to precious metal ETFs. So just by adding 1 + 1, there's a big inflow of passive investor funds via ETFs. They become more accessible to institutional money. And even if there's really no operational synergies to speak of at all, scale has seemed to help gold companies in particular. Now, it doesn't always work that way. There are a lot of, to your question about what to be cautious of, one of the real challenges of M&A is the post-deal integration. And I've seen a number of studies that have been done in the US and elsewhere, where the proportion of synergies that are actually realized by the integrated entity versus what was promised to shareholders to justify the deal, the proportion that's actually realized is shocking, and it's in the small minority. The number that sticks in my head is circa 20%. So 80% of the time, the end result from the merger is not as good as what was predicated as part of the deal. Now, those post-integration issues can be really enormous. It can be everything from some of the human resourcing aspects. A lot of the time, it's easy for someone who's justifying a deal to say, well, we got 2 of those accountants, we only need 1. There's your saving. But then when you get on the ground and you realize that it's not as easy as just shooting every second body in the entity, there's a lot of careful organizational planning that needs to go in there. And that type of complexity extends to a lot of different technical processes and operational processes as well. So I'm always very cautious when an M&A deal is justified on synergies. It's a little bit easier when it's justified on something as blunt as corporate structuring and access to capital.
I think that's a really, really good point. I mean, again, coming sort of from the debt perspective, when you look at how much gearing's coming into an M&A deal versus, again, the weighted average cost of capital sort of argument versus how much is going to have to be raised through capital markets. If the gearing is quite substantial, and obviously that's usually the intention to try and push that weighted average cost of capital down, then there's covenants and there's obviously cost efficiencies and savings that the companies would like to try and achieve to get that cost realized, or cost reduction realized. And if it's being pushed on the basis of that being realized through the M&A process, it's a real red flag to me that there's going to be some major challenges. I think your point about the scale and size and access to capital markets is absolutely a valid one, and probably one of the most important factors in an M&A deal, certainly on the corporate end. But when you start seeing discussions around trying to gear up the M&A, just because I think that they're going to realise those cost efficiencies, it's a really dangerous game to play.
But there's kind of human psychology at play here as well, because having been through sort of tough times and then come up with found another group who, like you, either see the opportunity or equally desperate, whichever side of that coin you're on, you find a potential financial solution to kind of get you through these tough times or open up the opportunities for the future. But money corrupts. Money corrupts thinking. I'm wondering how you, as a financier, would, what can you put in place? Or don't you care? I think most people think, but financiers just think about the fees and they don't really care. But I know different. You've got to set some goals in place for either the release of capital or the cost of that capital, or the ability to renegotiate the fees on that capital. So what can you put in place to ensure that management is a little bit more focused and stop them, doing what Brandon just said, which is, you talk about these synergies and these savings, but all of a sudden, once the money's in, you can breathe a sigh of relief and take it easy.
Yep.
And maybe relax in terms of your attitude to chasing those goals. So as part of the structuring, what can you do to ensure that perhaps they're kind of in line with expectations?
Well, there's a lot you can do if you're not just relying on capital markets. Obviously, if you as a financier and you focus on the debt side, there's a lot of things you can do in the structure, and typically it would be multiple tranches of the debt package that's being part of the deal. So there might be higher cost part of the debt package that's only a short term. It might be a year or two. That's based on realizing certain objectives based on that alignment, synergies that are expected to be achieved. So that's one factor, and obviously it's expensive, so the company will have a motivation then to try and realize that, or if they can't, they're going to have to try and raise capital to pay it out sooner. So there's different tranches, different penalties, different structures that you put in place initially that try and align to what the outcome that the company is trying to achieve.
Right, and so I was just thinking a little bit, Todd, because that's quite an interesting area. This, there have been deals. I think recently in Australia there have been a few deals which, well, certainly deals that have happened in the recent few years that perhaps been overpaid for it initially. They have structured it in a way which is not conducive to future success, and we've seen a few companies being mothballed. Do you, when you look at those deal structures, 2-3 years ago or 4 years ago, do you say, well, that's trouble coming down the line? And if so, what are those indicators for you that maybe I could spot next time I see some M&A happening? I don't need you to name names, but I'm sure you've seen a few.
Seen a few over the years, but look, I think the indicators to me. Again, back to the leverage that comes with the deal, and how much of that leverage is going to be supported by how many banks, and whether or not there is cost penalties, because they're not always fully disclosed how much the different tranches are established and what costs are around those particular structures. So that for me is one thing. But then it's if it's 1 + 2 = 3 or 4 or 5, then that's a real big red flag for me. If you start looking at pro forma balance sheets that are being forecast based on massive cost savings and synergies. And I think that's where it doesn't really matter how you structure the deal. You take a step back and go, well, this is going to be problematic because it's, as Brandon said, it's very difficult to ever realise all of those savings that are being forecast.
Brandon, what do you make of that? I know you come from the legal side, but you as an investor, you must see these signals as well. I mean, how do you read them?
Yeah, I agree with what was said. The other thing that you see quite a bit is, and this is distinct to the resources sector, like I think we should distinguish here between this niche here, which is resource sector M&A and other forms of M&A. A lot of the time out there in the industrial world, M&A is done because you're trying to access marketing channels. You've got a great product. Here's a bigger company that's already got the marketing channel, and they can bring that product to their customer base by owning that product, and it's a real win-win. There's a genuine synergy because you're taking a stranded product. It doesn't really work like that often in the resources sector. So there aren't the same highly compelling justifications that you see in the industrials. Quite often what you'll see is companies being acquired because they're in trouble, and the greater balance sheet strength or corporate strength of the acquirer is pulling them out from what could otherwise be a very dire predicament, such as foreclosure by banks or other contractual issues that they might have. And that's when, looking at it from an investor's perspective, you really need to test, does the logic hold together? If you've got an acquirer who's, let's say there's an asset that's in trouble, the justification for the acquisition is bigger brother's going to save them. There can be some real simple tests like, well, let's look at the facilities that bigger brother's got. Does it have enough existing undrawn capacity in those facilities to be able to do an injection of capital? If it does the injection of capital, what's it going to do to its own creditworthiness? Is it going to put the entire business at greater risk? Does that business have the risk tolerance for taking on what could be a bad apple? And there are plenty of examples where the bad apple has failed the entire corporate basket. But equally, there's good examples where it's a lot harder as a smaller company to do the same thing that a big company does. And often it's just that scale that makes the difference between an asset, like a mine, in a smaller entity struggling, and that same asset in a bigger entity with the collective resources and capability that a bigger entity's got. That same asset can really prosper. So for me, that's often one of the real distinguishing factors of resources company M&A versus industrial M&A.
Right. And I remember when I sort of came into this junior space a few years ago, not quite aware of all the kind of moving parts. There was a company that had, the management team had structured some incentives for themselves in there as part of the M&A. You've got a bunch of management team who have agreed on a concept, an idea of coming together, but then it's, show me the incentive, I'll show you the outcome sort of scenario where they had said, well, I'll tell you what, if we hit X target and Y target, we get a whole bunch of stock. It wasn't necessarily in interest of all the rest of the shareholders. So during these mergers, I mean, you must sort of have seen a few times and maybe sort of drawn breath occasionally when these sorts of incentives are factored into the M&A, because there's so much going on and everyone's desperate to do a deal that perhaps things, well, we'll let that one go, but you're going to give me something over here. Again, as a lawyer, probably looking into that, I mean, so one, do you see that, or have you seen that? And two, is there much regular shareholders can do?
Yeah, I mean, on the Australian Stock Exchange, the ASX listing rules impose certain restrictions on incentives or golden parachutes that can be provided to executives following a change of control. I can't talk to TSX or London as to what those restrictions might be. So that curtails the ability of executives to milk a transaction simply for their own benefit. And the legitimate incentives that are permissible by the ASX listing rules are more to do with ensuring that outgoing executives have enough of a soft landing that they're not going to stand in the middle of a deal that would otherwise make sense, because that's the other extreme. On the one hand, you don't want executives doing deals simply to feather their own nest. But on the other hand, the far bigger evil is executives who will refuse to do a deal because they're terrified of losing their job, or not being able to support their family or pay their mortgage, or any of these legitimate concerns. So a well-constructed corporate governance system will provide for that eventuality where if there is a change of control for something that really makes sense and, Executive A is out on his ear, well, at least he's got a soft landing and he's being looked after long enough to go and find the next thing and carry on with his career. Okay,
so that's the exchange. Perhaps looking after shareholders. In terms of your instructions as a financier, Todd, you just got to go along and do what they say, do you? Or can you make recommendations, and can you stipulate that perhaps what the management team want cannot happen? Because you've got to also protect the money in a way, haven't you?
Yeah, well, that's right. I mean, you've got to have a very tight, structured deal that's going to ensure that the alignment of interests are there, but it's got to be the alignment of interests across management teams, board members, as Brandon said, to ensure that they're still motivated to get a deal done. But ultimately, it's pretty simple as a banker. You look at cash flow, you look at repayment, and you look at security. When you structure up a deal, you're focused on those three things. You hope you never have to call security, because that's the absolute worst case scenario. But it's always got to be focused on the cash, because as a banker, you take the downside risk, you don't get any of the upside. Whereas the rest of the people that you're dealing with are the management team, who are incentivized by the upside. They're incentivized by what's going to come through from the equity markets, and their payday that they're hoping to achieve. So there's a lot of factors clearly at play that need to be considered. And I guess we're probably talking more about some of the larger type deals where there is a debt element. There's obviously a big portion of deals, as Brandon mentioned before, that are either off market or for ASX listed companies, they're more just straight equity transactions. And I guess some point maybe not to discuss right now, but we can get into it. But about the number of listed ASX companies there are on the market. There's over 1,000. I think there's 1,700 or so junior exploration companies alone, let alone the number of production companies or developers out there. So we're all essentially competing for the same pool of capital. So that in itself creates some motivations for companies at times to really look at how can they best access those markets. And Brandon's already made that point around scale, but the projects themselves have to, projects, management teams, strategies, as I mentioned before, all have to be aligned, and jurisdiction and all that. And we've seen a lot of that in the gold space, where you see, ASX listed companies who have a clear strategy. They've got one processing plant, maybe two, and they want to consolidate, try and acquire other companies around them to bring more production, into those processing plants. They make total logical sense. It's just then how do you structure it up?
And I think, really good points, Todd. And if we look at acquisitions rather than mergers, there is simply a natural progression in the resources sector of skills, where typically the people who know how to do generative exploration and are out there at the high risk end hoping to make a discovery with shareholder funds, very rarely do those management teams have adequate skills for developing an asset and certainly taking it into operation. So there's a very natural feeding chain that drives a lot of the acquisitions in this sector, where the end game is to discover something, prove it up, try and obtain optimal value for the work and the risk that you've taken on, and then hand it over to a company who's got the expertise to take it through the next phase.
Yeah, I think there's a difficulty in these sorts of conversations is M&A sit together and they often conflate it, and therefore it's very hard for people to kind of unwrap and unravel announcements which talk about mergers, which look like an acquisition, or acquisitions which quite frankly, it's debatable as well. But Todd, I want to come back to you on the financing side, because I think when I have seen some of these deals and I've seen some of the structured finance that goes on, it looks to me like the companies are not adequately structured, or quite frankly, banking on everything going smoothly. And it worries me. The things like maybe companies doing convertibles too early in the game, or to your point, maybe trying to loading on some debt with the assumption that it's near-term revenue and life will be good. There's no certainties in mining. It's tough. It's hard. Things go wrong every day. All that kind of good stuff. And the covenants and the securitization on some of these structured finance deals means that the penalties are big. It's a real problem. Is there a kind of and sorry to make ask you for a sort of generic statement like this, but because every project's different. Would you say companies of a certain size should or shouldn't take on certain types of financings? Do you feel that even advanced developers shouldn't look to debt until post FID? I mean, how do you view it as someone protecting the money potentially being allocated to a deal?
Well, look, it's a great question. Maybe at the end of the day, there's always going to be a market to provide some level of financing for any particular project. It just depends on what the cost is and what the challenges and the covenants are going to be. I can give you an example of years ago. Maybe I shouldn't name the company, but they were looking to develop a project, a lithium project in Western Australia that really was at a time when there hadn't been any developed at that point. So to get debt financing from banks was very, very difficult. So they had to go broader. They looked at convertibles and ended up taking out a bond, and that bond was extremely punitive in terms of the covenants and highly expensive. But it was the right thing to do. It gave them the opportunity to really get capital that they needed to advance the project. But they did it in a way that allowed them to continue to have relationships with banks. And I happened to be on the other side of that, where we had a small working capital facility in place. And that allowed the bank to get familiar with the project, the management team. And when the time was right, everyone knew that it didn't make any sense to try and hold on to that Nordic bond for a long period of time, the right way through to repayment. So when the time was right and those penalties were no longer as difficult as they were initially, it was refinanced, and the bank was able to do that and then bring other financiers into that process to substantially reduce the weighted average cost of capital for the process. So there's, I would be very cautious about taking on convertibles or taking on bonds that are highly punitive and highly expensive if you haven't exhausted all the other avenues of cheaper debt financing. In saying that, sorry to keep going, but in saying that, it is getting more difficult. Banks are less and less willing to fund the mining sector. We've seen a number of banks withdrawing over the last few years, including the bank that I was working.
Your old one.
So,
Your old one.
Yeah, so that's making it really difficult as you get to the point of wanting to fund a project. Here's the capital coming forward. The banks that are willing to do that, especially for single asset financing. I think that's the biggest challenge at the moment. Fully integrated upstream, downstream processing, that's probably always going to find a home, especially in the renewable space or battery metals space. But single asset project financings that were bread and butter for a lot of banks for a long time, very, very difficult to do these days.
That's also where the credit funds become quite interesting, and also with M&A. So for people watching out there, if I can have a go at simplifying the concept of a credit fund, they have a component of debt, but they obtain shared access to the upside through a variety of different mechanisms. It can be royalties, it can be convertible aspects to that debt, it can be warrants or options over the head stock. And we've seen those funding mechanisms being capitalised very well in recent times. There's a good appetite amongst investors to invest into those credit funds, and they provide a much more flexible mechanism than a conventional lender. And where they can play a good role in M&A is there can be a sharing of some of the more speculative advantages of an M&A transaction, potentially protecting the downside a little bit more, because these credit funds will take a share in that upside without being quite so focused on the downside as a conventional lender would, as Todd mentioned before.
But I'm sorry to stick with the financing, but it's a very important part, and I think it's a kind of critical part of these refinancings, because you use it as a position of opportunity of increased margins, which is what everyone hopes for, or as I keep referring to, slight desperation in the sense that they're running out of money, and this is a catalyst to get a headline which may generate some sort of interest and maybe drive that liquidity, or just keep the thing going to maybe try and live another day. So the money side of things is important. Todd, you mentioned, I always say desperate people do desperate things, and perhaps they take structures on board which they shouldn't, but in hope that it might at least let them get to the next phase and maybe allow them to refinance out at a later date. It doesn't always work out that way. I mean, what are these sort of alternative financings that these companies are available to companies? Because the big boys like BNP are saying too much value destruction. No, thank you very much. I'm off somewhere else in safer pastures. And we've seen alternative funds financing used as a phrase, either as part of this M&A activity or just in normal run of business. Are you seeing anything out there which you think is going to allow the kind of slightly broken mining sector to kind of regain some sort of credibility?
Yeah. Look, yes. I mean, obviously, you've got the credit funds that Brandon just mentioned. You've got, bonds, various different forms of corporate bonds that are available out there, or convertible notes, different groups that will provide, types of financing that will have all sorts of different challenges associated with them. But I think, to the point about the model being broken to some extent, I think that is a fundamental issue and the challenge that we're all going to be faced with going forward. There's no doubt, back to the point around the equity capital markets, we're all competing for this predominantly same pool of risk capital. If you focus on the energy transition, and we're both involved in that in various forms, that is a critical issue that's it's not just for the capital markets to solve, and I think while we will all be motivated by trying to get equity returns and get the upside that we're all hoping for, a lot of these projects are going to need support from government. It's going to need coordination across industry, governments, and capital markets to really get them off the ground. We see some major mining houses like BHP, who we've been involved with the BHP Explore program, who are putting in place these sort of initiatives that are really interesting and alternatives to supporting junior exploration companies like ours. Where they're selecting companies through a process, giving them a grant, they're working with them for a period of time, gives them access to a lot of information. They then do their due diligence. At the end of that process, they start working on whether or not they're interested in ongoing joint ventures. So that's one aspect and one example where you've got a major mining house recognizing that there's a challenge, but also there's an opportunity for them. And that's a chance for them to really partner up with companies like us, and other juniors out there. And I think we need more of that from industry. We also need more of that from government as well.
How do you feel about that, Brandon? Does the industry have to self-solve, or is it going to need government to kind of step in? Because it's a small sector, right? And we're chasing a small pool of capital. Will better projects, will mergers, self-solve this problem, or is it going to take more from that side?
It's definitely going to take more when you compare the responsibility that's been laid at the feet of the resources sector versus the consequences to the world's industrialized economies if there isn't a greater injection of capital. Now, that's perhaps more about the unrealistic expectations of policymakers around the world and the constraints that are being levied on the resources sector from almost every direction. So maybe it's a bigger discussion than simply where the capital comes from. But sooner or later, something's going to have to give. And whether it's the renewable sector, whether it's firming, whether it's energy more broadly across from coal all the way to nuclear power, the energy transition in particular is going to have extraordinary impacts across the society and industrialized life as we know it, at least in the developed world. Ultimately, that's going to be solved only by very large pools of capital, government being a good example, and then the super majors like BHP and Rio, BHP through Explorer is a good example where they're trying to get ahead, as Todd said, and start building those mentoring type expertise and capital relationships with prospective and very attractive development teams. Now, the problem is that if government doesn't play a role in making the journey more viable for smaller players, then they're simply creating a concentration of power amongst the very large companies. And that's not ideal for a resources sector that's going, in many sectors, going to have to increase by an order of magnitude between now and 2050 in order to supply the raw materials that these policymakers are simply writing into their political speeches as being viable.
But that's the thing that concerns me in all of this. You know, we say, well, the government must interject itself. Because we're talking about M&A today, but it's one tool that industry has in terms of ensuring that it continues on in some way, shape, or form, or as a chance to participate going forward. Government, we've seen with the Inflation Reduction Act, and Brandy, you're probably a bit more exposed to this than Todd, is a big chunk of money, but it's all gone downstream. It's all headed downstream and goodness knows elsewhere, but not a lot of it's heading back upstream to help the kind of the basic fundamentals of this stuff. You need these commodities coming out of the ground. You know, there's lots of talk from lots of governments about critical minerals lists, which have been around, 30, 40 years. No one's really paid much attention, it seems, to those things, but neither has government, in the sense that, well, what are you going to do about it in terms of that whole self-determination around these critical minerals, the security element around these critical minerals? Where's the money? I mean, when does it start cascading down into our sector? And Brandy, you're probably a bit closer to this. Did you want to go with that first?
Well, yes and no. I mean, I'd love Todd's thoughts on what the addition of nickel to the critical minerals list in Australia actually does. But in the meantime, there are some industries, and I think uranium, as it applies to the nuclear power sector, is one of the examples where there is a lot that government can do, very much in the downstream. A very substantial proportion of the friction for expansion of nuclear power falls at the feet of government, mainly through regulations, but also being willing to educate a populace about energy literacy and where energy comes from, and a realistic trade-off in various forms of risk from energy. There's a whole lot in the nuclear industry that government must do. And in countries where it does it well, you've got a thriving industry. And in countries such as Australia, where the government's playing an actively obtrusive role, well, you've got policy disasters in the making. Now, that then does filter a little bit upstream, but where I think the opportunities in the nuclear energy sector is for governments to enable the downstream to support the upstream, because the cost of capital for a uranium developer versus a nuclear power utility is vastly different. The scale of these entities are vastly different, but nonetheless, they're curiously symbiotic, because if the uranium developers can't bring on stream the supply that's required by those enormous nuclear power utilities, Well, both ends of that spectrum have got a huge problem. So there is a role for government to play, but I would say that that's a little bit more unique than other sectors, including where Todd works, where the OEMs play a much bigger role and have a different sort of interaction with government influence.
Good point.
Yeah.
Todd, I mean, OEMs, are they your saviour?
Well, we hope so. We hope there's at least a saviour out there of some sort. It's an interesting... look, I think it's a critical issue that we've got to deal with. Obviously our projects are in Europe. The European Critical Minerals Act was essentially the answer to the Inflation Reduction Act, or the equivalent of the Inflation Reduction Act in the US for Europe. It requires 10% of all raw materials now to be sourced from Europe. There's less than 2% at the moment. There's only 2 operating nickel mines in the whole of Europe, full stop. There's major challenges. And, I was at this conference only a few weeks ago where I was sitting on a panel discussion, and there was literally, I was the only nickel company there, and I was the only nickel explorer there. We're the only one with a project in Europe. And OEMs were all there. And that's why I was there as well. But, the debate and the discussion coming from the regulators and from government industry bodies or government bodies, was all about how do we secure supply and the alliances that we need to do with other countries, rather than looking in their own backyard and going, okay, there's a project here. Let's see how do we support an industry. That's how do we join the dots between where we're investing all this money in the downstream processing and building gigafactories throughout Europe. So many billions of dollars being spent on building these gigafactories, but no one's actually looked at where's the raw materials coming from to supply those. And then the big fundamental question comes, who do we want to be buying from? Do we want to have security of supply in our own jurisdictions where we're operating, or do we want to take the risk that we're going to be buying from one market, and that's predominantly going to be China? So that's the fundamental question, whether or not the governments themselves have to provide the funding. I think they could and they should, perhaps to some extent, but they also need to provide that facilitation to support, the development of industries and development of projects in jurisdictions where they want to secure supply.
Okay, I think we've kind of broadened the conversation of this, yes, the topic a little bit today, but in a good way, because these are all relevant points that we should be conscious of as investors, and making sure if we're going to deploy capital, we understand all of the potential issues and opportunities. But let's finish on a kind of positive a little bit if we can. I always used to, as a kid, love the end of the 9:00 news as we used to watch. There's always a happy story at the end about some ducklings escaping from a drain that they've been trapped in. So let's talk about some things to look forward to this year. Gold and precious, gold and silver, I've kind of gone on a little rip. Sitting just shy of 2,400 US, was amazing. Silver at 28, hitting 29. Mining more broadly, do you think that positive news story, that positive narrative and price gains in precious metals will start affecting some of the other metals out there in terms of sentiment, in terms of maybe an attraction back to equities? I mean, how are you calling this year, Brandon?
Okay, well, let's start with gold. What we see almost in every gold cycle is when the sector's been beaten up, the sentiment returns to the big end first and then very slowly filters down through the mid-tiers and ultimately to the developers and then the explorers. So there is a period of time where the economic power will be concentrated with those that are biggest. And I would expect that would motivate some M&A, and that would motivate some opportunities for those companies to make some value accretive acquisitions. And there will be inflection points where the bigger companies in gold will be very well capitalized and the smaller companies will still be capital starved. So now what does that do for other sectors? I think the most important thing is the flow of funds, and it can operate both ways. So yes, when investors are making money across the board, you see an acceleration in the flow of capital, and capital becomes more available to everybody. If it's a lot more patchy, So if you've got a situation where it's just, for example, gold, copper, and uranium that's attracting money, it can end up actually sucking the flow of funds out of other sectors where particularly institutional investors, they only want to put the money where they can justify it to their own investors and where they can turn those funds over in a short period of time. And I think we've seen that over the last several months. And the more dramatic examples, if you go to TSX over the last several years, with, for example, weed and crypto have sucked the flow of funds out of the natural resources sector. That happens in a smaller way when you've got a disproportionate degree of sentiment in one sector for another. So, and gold marches to its own beat. Like I certainly on a medium-term basis are very optimistic broadly on commodities and in particular natural resources across both the energy space, including conventional and new energy, but right through just about all of the industrial minerals. We're just going to need a huge increase in almost everything over the next couple of decades. The difficulty is what happens between now and when everyone else is prepared to act on that realisation. And we're climbing out of a very difficult period, generally speaking, across junior resources in particular. And it's the early progress that we're seeing in the recovery of gold and copper won't necessarily be good news for people who are operating a project in a sector that's not so attractive at the moment.
We'll say graphite. Todd,
yes.
Reasons to be cheerful?
I think there's lots of reasons to be cheerful. I think we're seeing definitely some, given we're seeing the activity coming back into the market, M&A taking place. I take Brandon's point about whether or not it's going to suck out the capital into everything across the space. That's often the case and always the risk. But I think getting any activity is a good thing. We're breathing some life back into the market, which is fantastic. I think, broadly speaking, the longer term outlook for industrial metals, in particular in the critical minerals that we're all focused on, is exceptionally strong. The outlook. We know that if we want to actually achieve all of these objectives that the governments are looking to try and achieve, we need a lot more. Not only nickel, nickel's obviously getting hammered because of the oversupply coming from Indonesia. But we look at the amount of supply that's coming from Indonesia, and the sulfides that have been stopped and put in care and maintenance. We need all of that Indonesian supply. We need all the sulfides that have gone into care and maintenance, and we need a lot more new discoveries to ever get anywhere near the amount of nickel we need in the market for the energy transition. So I'm still very optimistic on that one, in that commodity in particular, but obviously, of course it will be. But in copper and other minerals, lithium, I think, come back. It's no doubt that we need it all, and it's going to bring more sentiment back into the market. People have just been really cautious in the last 6 months and very risk averse.
Guys, I think we better leave it there. I know that you've got a family to get back to, and so have you. I appreciate making time to help educate our humble little audience, and hopefully people understand M&A just that little bit more after listening to you guys. Thank you very much.
Thanks, Matt. Absolute pleasure.
Cheers.